and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. I'm joined today by Erik Savi, our Global Head of Infrastructure Credit, a space he's been investing in for the last 34 years. Erik, thanks for being with us.
Thanks for having me.
Erik, a lot of people are familiar with infrastructure as an equity investment space, but how would you define infrastructure credit as an investment opportunity?
Well, infrastructure credit, at the time I first started my career, was known as project finance because what we were financing were projects rather than corporate entities. And so what we're really doing is making debt investments in where somewhere in the capital structure there's a real asset that provides essential services to the general public, where there's typically a predictable cash flow associated with it.
And what are some of the macro trends you see today that make infrastructure credit an interesting space to invest?
Well, I think it boils down to just a supply-demand imbalance that we see in the infrastructure credit space. If we just focus on the demand side, certain drivers of that investment activity, one common theme is energy transition,
Sure.
Right? The move to net zero, cleaner energy, driving significant investment in renewables. And estimates range roughly $4 trillion of capital that's required through the end of the decade to aid in this transition. Another driver is transition to a digital economy. That was already occurring pre-COVID, during COVID, because of the work from home environment and now the resulting hybrid work environments. It's just massive need for faster data delivery, greater data storage. Estimates range, on the order of $9 trillion of capital required in the digital space through 2040. Now, if we switch to the supply of capital side, pre-global financial crisis of 08-09, it was the commercial banks that provided almost 90% of the capital globally to finance infrastructure projects. And the more restrictive capital rules that were enacted out of the global financial crisis, bank balance sheet stress testing, bank balance sheet capacity has become diminished. Institutional investors are ripe for picking up that capital slack. So at a time that there's a significant capital demand for infrastructure and the lack of supply, there's very good risk-adjusted returns that could be had in the space.
There's so many areas of infrastructure that you could invest in. When you look at the opportunity set today, where do you find the best value?
I mean, the short answer is there is various pockets of opportunity. But the ones we're most excited about, I would say, are energy transition and digital infrastructure. In terms of energy transition, I mentioned, the massive capital that's required. But one interesting data point is if you think about capital supply, even though bank balance sheets have been more diminished since 08-09, one area, one sector that they've heavily been investing in is renewables. Mm-hmm. Well, if you recall what happened last March, you had the collapse of SVB Bank, the contagion that spread to the other U.S. regional banks. They were major investors in renewables. And so that balance sheet, is significantly diminished. That has resulted in very attractive relative value today for renewables as opposed to, even 12 months ago. Mm-hmm. Digital infra is the other interesting opportunity. Same reasons. Banks were aggressive lenders also to digital infra. Because of less competition, relative value is really attractive there as well.
Now, for investors that are allocating across asset classes, how should they think about infrastructure credit as part of their broader portfolio?
Well, there's a number of benefits for the asset class. First and foremost, it's a defensive nature of the asset class because they provide essential services, because there's predictable cash flows, there's lower defaults, lower loss rates. The other benefit, I would say, is attractive risk-adjusted returns. And then finally, the diversification benefits, low correlation versus corporate credit.
Right. Low correlation, low loss rates, and some strong risk-adjusted returns. Lots of things to like in the asset class. Erik, thanks so much for your time today. Thanks to all of you for tuning in. We'll see you next time on Insights from the PM's Desk.